Welcome to the show, Bill. Good to see you.
Thanks for having me.
Thanks for being here. Let me start by playing for you a recent piece of commentary by Ray Dalio, founder of Bridgewater Associates. Take a listen to what he says here about the economy, and maybe we can, respond together, and you can share your own thoughts as well.
There are basically five big forces through history that drive everything. First, there's the money, credit, debt, economic cycle, in which there's a building up of debt in a cyclical way that becomes too large, and we're going to have problems. We're going to have a government debt problem. Maybe we can get into this. The second big force through time is the internal conflict force. The left and the right, differences in wealth and values causing a conflict that we're seeing it changing our political order. So the first is changing our monetary order. The second is changing our political order internally. And then the third is the great world order, how countries deal with each other. When there's a rising power, challenging an existing power. And now we are going from multilateralism, which is largely an American world order type of thing, to a unilateral world order in which is great conflict. And the other two factors all through history have been acts of nature, droughts, floods, and pandemics. And number four is technology changing. And how they are coming together are the main forces behind this.
Two comments I'd like you to address, please. So the first is whether or not we're moving from a multilateral to unilateral world, which is what he talked about towards the end, and the first debt problem that America in particular is seeing, but all around the world. But I think he was talking about America.
Yeah. Who am I to argue with Ray Dalio? I think he's, identified some of the major structural forces at play starting to, be in a period, we're starting to be in a period of significant change under this new administration, the Trump administration in the US. But let's start maybe with the latter, where Ray started and you finished with the budget deficit and the outlook for debt. Budget deficit is something at DoubleLine that we've been highlighting, for the past several years as a growing risk to the outlook for the fixed income markets, especially in the United States. It was our view that we've run larger deficits than we have any time outside of wartime or recession.
Yeah.
Leading into this year, we are sitting at a budget deficit of about 6.5% of GDP in the United States, debt levels running around 100%. And then we look at this outline that Congress has now passed for the reconciliation process. And it really makes us, quite worried that, any serious effort to try to address what are these very large and growing outlooks for the debt and deficit in the United States will be addressed in a timely manner. And the reason that's important for fixed income markets is, along with this warning, we've been saying that we thought the back end of the yield curve in whatever the next downturn or financial issue for markets would be, we thought these debt and deficit issues would make the long end of the yield curve less sensitive and not behave in the same manner as they had in prior drawdowns. And we're actually, starting to see this play out. The correlations for long-term U.S. Treasuries to be a risk-off hedge in portfolios now has, started to come under some question recently. And I think, we're going to probably spend a lot of time peeling the onion back, because I think that there are a lot of factors at play, that make this a risk that all investors should take note of right now. Just quickly, his outlook, for the globe, I maybe am taking a little bit different. I'm taking a little bit different approach to the outlook for a multi. I think what I'm looking at in from my global perspective is a world order that was dominated by the U.S. security guarantee. the US dollar underwriting all trade and the majority of global transactions around the globe. And due to a large political shift, all rightly identified by Ray Dalio, we had wealth inequality, reaching historic levels, and we've seen fairly strong polarization, of many political parties, not just in the U.S. But the net impact of that has been a move towards more protectionism, and the U.S. stepping back from their prior position as a global leader as far as providing security guarantees, and also the free exchange of the U.S. dollar. So what I think we are starting at, what we're at the beginning stages of right now, is a movement away from a dollar-based global trading system into more of a multipolar based trading system. And what I've written extensively about this, and I direct your viewers to some of the writings that I wrote several years ago, when the U.S. sanctioned Russia and U.S. and Europe pulled them off of SWIFT, froze their FX reserves, and really weaponized the U.S. dollar-based financial system that kind of started this move. But now the protectionism and trying to adjust global supply chains is now speeding this process up, where I think many nations are starting to evaluate or reevaluate their holdings of US dollars and US treasuries. And I think that the landing zone that we're going to end up in is one where we're going to see an acceleration of global central banks looking at their regional trading partners, their balance of payments. So they're going to look at, who do we actually do trade with? Who do we actually, engage with most of our financial transactions with? And our currency, the reserve currency basket, should reflect those relationships, not just the, broad holding of the US dollar. And we've already started to see movements in this direction with the, explosion of RCEPs, or regional trading, agreements. There's also been a lot of memorandum of understanding between central banks that are allowing bilateral settlement between countries for trade and financial transactions that don't use the US dollar. And let me just give you one quick example. Why is it that Australia and Singapore, for example, just to name a couple off the top of my head, should need the US dollar to intermediate trade and financial transactions between those two countries? I think that, they would argue that a bilateral settlement system using their own dollars, would make just as much, if not more, sense. So, I think I think Ray Dalio was trying to address, maybe the rise of China. And when I have heard a lot of discussion around the dollar, being replaced as the reserve currency, the pushback that I've gotten is, well, who is going to be the new king? Who is going to replace the dollar? And my argument there would be, I don't think there's going to be one new king. I think we're moving to a multipolar world where each country is going to be looking in their own best interest, or their own, economic interest, of who do we engage in trade and financial transactions with. And, that is going to then much more closely, reflect the currencies that they choose to hold, as reserve currencies to cover. Really, reserve currencies are to cover, your imports in a shock. And if you have a bilateral relationship with many, with your trading partners, there's no need to then have a third-party currency, being the U.S. dollar, to intermediate that. Now, granted, there are, some exclusions as you move down the emerging market spectrum, where, there could be questions about the stability of currencies. Maybe at that point, dollars and euros may be used as, a surrogate in those cases. But the overwhelming portion of the US dollar that's dominating the global financial and the global trading system right now, I think with all the tectonic shifts that are taking place, from global trade to security relationships, are moving us into a direction where we're going to have a much more multipolar world going forward. So let me stop and see.
Yeah.
There's a lot to unpack on both of those, but where would you like to start?
Absolutely. Well, let's just start by taking a look at how the markets are interpreting these events, and then we can drill a little bit deeper into some of what you said here. So this is the 10-year bond yield. It's spiked up from 3.8% all the way up to a high of almost 4.6. It's come back down a bit in the last 2 days or so. Bill, why have yields gone up in light of escalating tariffs? As you'll recall, in early February when Trump announced tariffs, the reverse happened.
Right. So let me set the stage. Just keep this, please keep
Yeah,
this for now. I think we need to go, we need to set the stage by looking at a little bit longer spectrum.
sure.
Over the past, it's going to be a little bit longer than what what you have
Sure.
here, but let me just, set the fundamental picture, and then we'll jump back into what's happened recently. Over the past decade and a half to 2 decades, the globe has experienced a period of either zero or negative interest rates across developed markets. We've seen, a period where, on a relative basis in developed markets, the U.S. Growth has outperformed, many of its developed market peers, and and post the WTO. The expansion of global trade has really allowed the U.S. consumer, to enter the globe and be really the globe's consumer. And what's happened there has, you've seen, a couple of forces come together. As the U.S. Consumer has been able to, import cheap goods globally, we've been able to, our capital has been exported across the globe. And as exporters across the globe have held these dollars and had to make a decision. Do I want to invest to repatriate the dollars back into my local markets and invest locally where yields have been low and growth rates have been low? Or do I want to go back into U.S. assets because I hold the dollars? I can invest them in U.S. financial assets where growth has been relatively higher. And as we've seen, equity markets and yields also on a relative basis, have been relatively higher than developed markets as well. And what we've seen is that choice has been for global savings to come into the U.S., in a fairly substantial manner for the past decade and a half. When we look at the amount of global savings that sits in the U.S., the BEA calculates just the portfolio flows alone, international foreign investors purchases of equities and fixed income and agency fixed income, a little bit above $30 trillion as of the end of last year. Those are the 4Q numbers that, are the latest numbers that, the Commerce Department's BEA has released. But that's 33 trillion of foreign savings sitting in liquid assets. When you add on top of that real estate investment and other investments, that balloons up to 60 trillion. That is a substantial number. And when you look at the chart of, those inflows, it's steadily gone up. There were a couple of dips, one for COVID and then one for the 2022-2023 rate rise, that hit markets and fixed income markets. So for a long time, multiples in the U.S., were better than most developed market peers. Earnings growth in the U.S. was better on a relative basis than most of its global peers. So we were both the consumer of the globe, but also the safe haven for portfolio and investment flows as well. And now with the change in policy, both we've run a profligate fiscal policy, as Ray Dalio and we talked about briefly at the beginning, but also from the trade standpoint, we're trying to readjust global supply chains in a fairly immediate manner, which is going to cause a systemic shock to growth across the globe, but not just outside of the U.S., inside of the U.S. too. And I think what we are starting to see is the foreign investment community take a step back and say, you know what, we need to repatriate, some of these flows. At minimum, we're going to stop the investment, but we're going to start to repatriate some of these flows. And I think that these concerns that foreign investors outside of the U.S. are going to have now about the outlook for U.S. returns and also, the U.S. fiscal or U.S. Treasury supply are going to stick with us at least until we can address, these huge policy questions in a medium term. And there is this large stock that, can start to move out. And I think that really what, we've started to see just the beginning of, so you pointed it out a couple of weeks ago when we really started to see U.S. assets, equities, take a downturn because of the tariff announcements. We expected to see that treasuries, would have also followed, and they didn't. The long-term treasuries, actually, the yields backed up, price went down in sympathy with what we consider risk assets, which they're supposed to hedge, the NASDAQ and S&P. Well, one of the most popular strategies for investing, and especially across the past decade, has been risk parity, right? So you're in whatever manner you want to do it. It's 60-40, 70-30, vol adjusted. You are trying to use fixed income to hedge your equity. And what we're seeing now is, they're both being unwound at the same time. And that would suggest to me that you could see, people just unwinding the overall broad-based U.S. exposure and starting to pull that back. And it's now causing more concern in markets that, these underlying, it's bringing, I should say, bringing to the surface what, was under the surface, these underlying structural factors, that I keep going back to, but I think are extremely important, that we are on an unsustainable debt and deficit trajectory if we don't address things in a fairly short order. And I am concerned for what the outlook, for growth is if we are meaningfully trying to, reestablish a global order that is moving away, from the global supply chains and trading that have currently been in place for the past 2 decades, or actually since China's accession into the WTO, and also with the Mirren article, if the U.S. is really taking a step back from providing global security guarantees.
I think some people may look at this chart, Bill, over the last couple of days or so and reminisce about 2022 when something similar happened, which is that bonds and stocks fell together. I know that in 2022, the Fed had a completely different monetary policy than now. They were in the process of fighting inflation. But could the same thing happen this year, where we have bond yields rising and stocks falling at the same time, and in which case the 60-40 portfolio would break down?
We're concerned that that could play out, but again, in 2022 it was an inflation. This was truly an inflation-driven issue. This year, although implementing tariffs may have an initial price level adjustment, we think that the growth adjustment lower will help offset any lingering impacts of inflation. We are getting more and more concerned that this year, if we do go into a fairly aggressive growth slowdown, then you're going to have automatic stabilizers kick in. We're starting at such a low level, at such a negative level for the deficit already. And the need to fund the deficit. When automatic stabilizers such as unemployment insurance kick in, that's just going to naturally expand the deficit by another 2 to 3 percentage points on top of that. So that on the long end of the curve, is what is making us concerned about the 60-40 portfolio right now. But what I would say is we think that the front end of the curve, when you're looking at the 2-year to the 5-year, maybe 7-year, the belly of the curve, should on the other hand, still be able to provide you, with the protection that you're looking for. And so, in our firm, what we're doing is we're underweighting the long end exposure of the curve, and we're taking, the risk that we would normally put in the long end, and we're putting it in the short end. The short end of the U.S. yield curve is much more closely linked to Fed policy, and it's tied in tightly to Fed policy. And now that the Fed has, addressed any potential slippages in being able to maintain control over the short end of interest rates by introducing a standing repo facility, about 8 years or 9 years ago. We think that relationship still will continue to hold up. We think that in the near term, the Fed is going to be cautious about any cuts until it sees unemployment, layoffs really start to pick up.
Yeah.
Because of all the tariff uncertainty, they're going to be concerned that rise in price levels, if it's not followed immediately or simultaneously by a downward shift in growth, then it does run the risk of prices, price feedback loops picking up, and prices remaining elevated if not picking up. So then in the near term, the Fed may be on hold and may start to frustrate markets just a little bit. But we ultimately believe that the growth shock that will come through from aggressive tariff policy and the rising probability that, we're bringing a recession forward, the more aggressive the tariff policy and the trade policy that we try to implement in a short period of time, the more the probability that, growth is going to be hit goes up. And then we think that ultimately that will feed through both to allow the Fed to eventually cut interest rates, maybe more towards the end of the year rather than June, which is where the Fed, right as of today, the first Fed cut is being priced. We think that that's likely to be pushed back later this year. But when they do cut, they will be cutting more aggressively because of a growth slowdown. And we do think, again, that front end of the yield curve is where you will be able to get that protection, not the typical buy the 30-year part of the yield curve, which a lot of the risk parity strategies have been based on.
Because the front of the curve follows the Fed funds rate. Is that
exactly right?
Yeah.
And it still should, because of the reasons that I laid out.
Well, does the long end of the curve, the 10-year, for example, have any predictive power on monetary policy? In other words, if the 10-year is going up, will the Fed fund rate follow?
No, we tend to think the 2-year has predictive power on it. So we follow much closer what the 2-year is doing, and we think that the issues around term premium on the long end are going to confound any use or the predictive power in the past that the 10-year might have provided. But also once the Fed starts cutting, the long end of the yield curve, all else equal, can start to, after the Fed starts their cutting cycle, can continue to steepen. So, that's something that, again, in this time where, when the Fed starts cutting rates, the curve generally tends to steepen, front end yields do better, historically. Also with, the continued concern about the term premium, we think steepeners and front end of the curve make a lot of sense in the United States.
Why would the Fed need to cut more aggressively towards the end of the year, like you just said? The latest inflation numbers came down a little bit from the previous month, so one could argue their current monetary policy doesn't need too much changing for inflation to just be coming down on its own. Are you expecting the labor market to worsen, which is the other side of what they're looking at?
Yeah. So when we look at the last inflation print, it was March, and we've seen a drop in oil prices, and we were on base effects from the pass through of what prices were last year. We expected the March print to be a little bit lower. Granted, it came in just slightly below expectations. Tariffs have really started to be implemented in force. Well, we got the 10% baseline, and then the China tariffs in April. We'll see probably more after that. So we think that those would have, again, near-term level impacts. And then exactly right on the employment side, the U.S. employment picture, has been historically, very strong. We're starting, at unemployment levels, around historic lows. We have not seen, even with, the Doge cuts, we haven't seen precipitous rises, in unemployment claims. Those have been, relatively well behaved as of recent, releases. The non-farm payroll prints have continued to come out, in line with expectations and not showing massive layoffs yet. And the employment side, does take some time, to start. It generally lags, the real economy. And, I think the Fed, especially given these near-term price concerns and their uncertainty about, second round pass-through effects, I think they're going to be more cautious, in the near term and wait to see, the second half of their dual mandate, the unemployment, picture start to weaken before they cut. But by waiting, then you end up in a situation where I think they're going to need to play a little bit of catch up because the way the employment picture weakens is with growth weakening, even more, than what we're currently than what the market's currently anticipating. So the risk is they have to wait and, then be a little bit more aggressive, towards the end of the year. You could see they could end up doing 100 this year, but doing it with 50 basis point cuts towards the end of the year instead of being able, I should say, to get these 25 basis point cuts in. And I think when you listen to Powell, he seems to be, suggesting this tone of caution in the near term. And, I think that at least as of today, that's the way I'm reading, both the Fed and the economic outlook that's going to follow.
This just segue into what you said about the economy. Here is an article from the Financial Times. Warning lights flash for U.S. consumer strength as credit card defaults rise. U.S. consumers are showing increasing signs of financial stress as they brace for higher prices from the Trump administration's tariffs. In the first quarter earnings, JP Morgan said the portion of loans in its credit card business deemed unrecoverable rose to a 13-year high. It's now higher than before the COVID outbreak, during which credit card actually delinquencies went down, not up. Consumer spending is the bedrock of the U.S. economy. How will this progress? How will rising yields, especially on the long end, affect consumer strength?
Yeah. So I think we need to, take a step back and just look at, the overall machine that's at work here. Uncertainty over tariff policy is basically freezing boardrooms from being able to make any capital budgeting decision at this point. They don't know what the rules of the road are. Are they supposed to build a new factory in the US? When we look at the tariff policy, went pretty aggressive on Asia, but most of Latin America was at, before we, did the 90-day delay, most of Latin America's reciprocal tariffs were at the baseline 10%, while Asia had all of the additional tariffs from Vietnam at 46. Obviously, China was very high. Malaysia was in the 30s. You saw, a lot of, the Asian supply chain, was hit hard, by this tariff policy. But it's not clear what what are the goals that, the Trump administration is trying to ultimately achieve. Do they want all production to come back onshore to the U.S.? Will this idea of nearshoring or friendshoring pick back up? Will there be a requirement that we're just trying to remove China from the global supply chains and that everyone will be, discounted if they put their own Chinese tariffs and trade barriers up? And I think that most boardrooms and most multinational companies are ready and willing to, try to figure out, negotiate deals with the United States, but it's not clear to them, what the starting point, for these deals are. Mainly, what is the objective? What is it, that is trying to be achieved here? And so while that's capital budgeting and capital spending is frozen, we're starting to see that it's going to hit on growth, but margins are getting squeezed. And then as margins get squeezed, the next domino to fall is addressing payrolls. And I think consumers are, now seeing equities fall. They're seeing uncertainty in the global supply chain. And I think, the worry that you could see a layoff cycle pick up is also, hitting consumer confidence and, is likely to feed more through the consumption and spending channel as well. So, again, I think that it's good to look at each piece of GDP from consumer to investment individually. But as I pointed to, there are these feedback loops that we need to pay attention to as well. And once they kick off, I think it's very hard to stop because you get consumer spending, starts to drop, the consumer retrenches. Well, then you see earnings start to fall because revenues and sales are going down for companies, and the loop continues. So we're, right, we're coming from a very strong, standpoint. Coming into this year, markets were at all-time highs. We had decent economic growth, a very strong global employment and wage picture. And, now we're starting to see cracks on the margin. And the longer, this is a race against time. The longer that these policies and uncertainties are dragged out, the longer that we don't know the final landing place, for what is the objective that the administration is trying to achieve, the bigger the risk that you end up in a situation where, we enter into, a sharper growth slowdown that leads to increased layoffs and hits consumption.
Yes. So ultimately, then, should investors be staving off their treasuries allocation, except for maybe the short end of the curve?
Well, again, we favor the short end of the curve. I think we need to be cautious on the long end. I think that, for the near term, the outlook is highly uncertain. So, you may have to wait a little bit for, the front end of the curve, trade to play out. But I ultimately think that, the belly to the front end, we should be reducing duration, in portfolios. That does make sense.
Okay. And recession outlook, what is your or your firm's assigned probability of a recession this year, and how does that impact allocation?
Yeah. So we've been raising, like, we were actually, one of the first, well, we were early on to raise our recession outlook above, to above 50%, about a month or so ago. Our concern was all of the policy changes that were coming through. We weren't, fully aware of what the reciprocal tariffs would be, especially them coming out on the high side. But we were concerned, that all of these policy changes, would be feeding through at least to near-term growth. With that, with that in mind, for over, pretty much over the past quarter and, a little bit more, we first started upgrading the quality of all of our portfolios, moving, to higher rated AAA, AA investments. We also have been improving the liquidity of our portfolios, moving out of less liquid sectors into more liquid agencies and front-end treasuries. We also, have been implementing the curve steepener, where, we think that, again, we still want to maintain some, duration risk to offset, the potential for, more, growth, negative growth outturns and, financial volatility shocks. But we think that the positioning on the yield curve that will get us that type of protection, again, is more in the front end to the belly of yield curves rather than the back end.
Thanks very much, Bill. Great meeting you. Great talk. Where can we learn from you and follow your work?
Yeah, well, please go to doubleline.com to see all that DoubleLine can do for you.
All right, we'll put the links down below, so make sure to follow DoubleLine there. Thank you again, Bill. We'll speak again soon. Take care for now. Thank you for watching. Don't forget to like and subscribe.